Welcome back to Talk Tickers. This is the show where we strip away the PR fluff, we ignore the glossy slide decks, and we get straight to the P&L.
We dig right into the numbers.
I'm your host, and today we have a massive stack of research on the table. We're talking earnings, we're talking caffeine, and we're talking about a market reaction that, it nearly broke the after-hours tape on Thursday.
That is not an exaggeration. It's good to be here. And frankly, looking at these sources, we have a lot to unpack. We are doing a deep dive into Dutch Bros, Inc., ticker symbol BROS.
The drive-through coffee chain that feels more like a rave than a cafe sometimes. We are breaking down their fourth quarter and full year 2025 results.
And what a set of results it was.
It really was. Now, before we get into the spreadsheets, we have to talk about the vibe check. Because if you were watching the market close on Thursday, the sentiment was, well, it was bleak.
Bleak is the right word. The stock had been struggling significantly. It was down about 18% over the last month leading into this print.
18% in a month. So the market was pricing in a disaster.
Absolutely. The narrative on Wall Street was skeptical. The bears were yelling about growth concerns and market saturation. They were convinced that the high growth phase was over and that Dutch Bros was hitting a wall.
And then the numbers hit. The stock closed regular trading around $50 a share.
Right around 50. And then 15 minutes later,
it's trading near 59, a 12 to 13% rip in after-hours trading. That is a violent repricing.
That's a classic show me moment. The market was pricing in a slowdown and management delivered an acceleration. In a quick service restaurant or QSR environment where almost every other chain is fighting for foot traffic and relying on aggressive price hikes to survive.
Which is everyone, right? That's the whole industry story.
That is the whole story. And Dutch Bros just posted transaction growth that makes the rest of the industry look caffeinated but stationary.
That is the hook for today's deep dive. How is a coffee chain generating massive volume growth when the consumer is supposedly tapped out? We're going to look at the traffic anomaly, the new food strategy that is changing their unit economics, and a very interesting acquisition that I don't think anyone saw coming.
No, that one came out of left field.
But let's start with the results snapshot. Give me the headline beat. What did the top line look like?
It was a beat across the board. Let's start with the top line. Revenue came in at $443.6 million for the quarter.
43.6, and what was the street looking for?
Now, the consensus estimate, what all the analysts were modeling, was around $425 million. So they beat the street by nearly $19 million.
Wow, which for a company this size is not a small rounding error. That is a significant delta.
It's huge. That represents a 29.4% year-over-year jump in revenue.
Almost 30% growth.
30%.
Yeah.
In this macroeconomic climate, finding a consumer business growing the top line at nearly 30% is like finding a unicorn. Most of the sector is happy with low single digits, if that.
Okay, but revenue is vanity, profit is sanity. Do they make any money? Because the knock on high-growth companies is usually that they burn cash to get that growth.
They did make money, and that, I think, was the bigger surprise for the market. Adjusted earnings per share, or EPS, hit 17 cents.
17 cents. And the expectation was?
The street was expecting 9 cents.
Whoa. So they nearly doubled the profit expectation.
Correct. And this addresses the biggest criticism of Dutch Bros over the last 2 years, that they could grow sales, sure, but they couldn't execute on efficiency. This quarter just proved otherwise.
So the profits are flowing through.
They are. Let's look at adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization. It's a good measure of cash flow. It came in at $72.6 million. That is up 49% year over year.
Okay, I want to pause there because that metric matters. Revenue was up 29%, but EBITDA was up 49%. That is the definition of operating leverage, right?
Exactly. It is the holy grail of scaling a business. It means for every incremental dollar of sales they brought in, they spent less to generate it than they did in the past.
Their costs aren't growing as fast as their sales.
Precisely. They are scaling their corporate costs, their SG&A, better than their revenue growth. For the full year, they finally broke the $300 million barrier for EBITDA. It's a clear profitability pivot.
Okay, so the accountants are happy, but as an investor, I care about the health of the brand. We need to talk about the metric that really matters for any retail business. Same-shop sales, the comps.
The holy grail metric.
Right, because you can grow revenue just by opening new stores, but are the existing stores actually growing? Are they healthy?
This is where the report really shines, and it requires a bit of nuance. System-wide comps were up 7.7%.
7.7, which is a great number on its own.
It's a fantastic number. That's a blended number of franchises and company-owned shops. But if you strip that back and look only at the company-operated shops, which now make up about 70% of the entire system, they were up 9.7%.
Almost double-digit same-store sales growth. In 2025, when Starbucks is struggling to keep comps flat and McDonald's is fighting tooth and nail for every customer, that seems almost suspicious.
It does, doesn't it?
Is this just inflation? Did they just jack up prices by 10% to get that number?
That is the question I asked myself immediately. Because usually when you see a plus 7% comp in this economy, you dig in and you find out it is 6% price increases and maybe 1% traffic growth.
Or worse, negative traffic masked by high prices.
Exactly. That has been the story of the entire restaurant sector for the last 18 months. Pricing power masking demand weakness.
So did Dutch Bros pull the same trick?
No. And this leads us to our first deep dive segment, the traffic anomaly. This is, I think, the most important part of the entire report.
Let's get into it.
Dutch Bros flipped the script. In Q4, system-wide transactions, we were talking about the actual count of receipts, the number of cars in the line were up 5.4%.
5.4% more orders, not just higher prices, but more people.
More people. And again, if you isolate the company-operated shops, the number is even better. Transactions at company shops were up 7.6%.
Okay, that is the single most important number in this entire report.
Without a doubt.
Because that proves demand elasticity. It proves that even though the consumer is pinched, even though inflation is real, they aren't cutting out their Dutch Bros run. They aren't just paying more people are showing up.
Exactly. Management highlighted this on the call. They said the industry is fighting a value war. You see it everywhere. McDonald's bringing back the value menu, Burger King doing 2 for $6 deals, everyone doing buy one, get one offers.
The race to the bottom on price.
It is. They are trying to lure people in with the dollar menu equivalent of coffee. Dutch Bros isn't playing that game. They're winning on customized energy and speed.
Yeah.
It's an experiential brand, not a commodity one.
But they did raise prices, right? They aren't a charity. They have to pass on costs.
They did, but modestly. They noted they are taking a small price increase in 2026. They had about 1 percentage point roll-off in January, and they have another small hike coming in July. But the growth isn't led by pricing, it's volume-led.
Volume-led growth. It sounds so much healthier. It means you have pricing power in reserve if you need it, but you don't have to run it just to make your quarter.
Precisely. It is a position of strength versus a position of desperation. When you are chasing volume with price cuts, you destroy your margins. When you get volume naturally because people want your product, you protect your margins and can choose when to use price as a lever.
Okay, but let's play devil's advocate. Volume's great, but how are they actually driving it? Is it just hype, or are there structural levers they are pulling? Because eventually the hype dies down, the cool factor wears off.
That's the key question. And it's not just hype. They are executing on 3 very specific strategic levers that are creating this growth. This brings us to the next part of our analysis: strategic levers and innovation. And the big one, literally on the menu, is the food layer.
The food program. Okay, I have been skeptical about this. Dutch Bros is a beverage company. Their whole brand is built on speed, on throughput. You know, get in, get your rebel, get out.
Right.
If you start selling sandwiches, you risk clogging up the kitchen. We have seen this happen at other chains. You add food, and suddenly the drive-through line stops moving because someone ordered a panini that takes 3 minutes to grill.
That was the fear, the operational drag. But the data from this quarter suggests they have solved for it. This food program is no longer a test. It is a driver.
Okay, so what's the data?
They dropped a data point that made my ears perk up. Shops with the full food program are seeing a roughly 4% comp lift, specifically attributed to food attachment.
4% lift just from adding snacks. So on top of the already high growth, the stores with food are doing 4% better.
Correct. Think about the unit economics. You have the customer in the drive-thru already. They are buying a Rebel energy drink or a freeze. If you can get them to add a chocolate chip muffin top or a savory twist for $3 or $4, you are increasing the ticket size, the amount of money spent per transaction, without really increasing the labor time.
Provided the operations are smooth.
And that is the key. They have designed the menu for throughput. The food isn't made to order from scratch. They aren't frying eggs back there.
There's no grill.
No grill. It is a heat and serve efficiency model. It is designed to be grabbed and handed out as fast as a drink. They are using high-speed ovens that have it ready in seconds. It's all about maintaining that speed.
So you get the revenue bump without the throughput penalty. That's the holy grail of adding food.
Correct. And it solves the veto vote problem.
Explain that for the listeners. I feel like we all know it, but maybe not by that name.
The veto vote is a concept in dining psychology. If a car full of 4 people is driving around and one person is starving for actual food, not just a drink, they will veto the coffee-only stop. They'll say, no, let's go to Starbucks or Dunkin' because I need a sandwich.
Right. I need something more substantial.
By having a viable food layer, even if it's just a few good items, Dutch Bros removes that veto.
Yeah.
It expands the daypart utility, meaning people can go there for breakfast or a midday snack, not just for a drink run.
That makes a lot of sense. It's defensive as much as it is offensive. And they expanded this to how many shops in 2025?
They expanded it to 300 shops across 11 states in 2025.
And the full rollout is when?
They expect a full system rollout by the end of 2026. So that 4% comp lift, that is a tailwind that is going to blow through the entire system over the next 18 months. It hasn't been fully priced in yet because it's not in every store.
That's a built-in catalyst right there. Okay, so that's lever number 1. What's number 2?
Lever number 2 is digital. Because speed isn't just about how fast you pour coffee. It's about friction reduction. It's about taking steps out of the process.
Then this is where their app comes in.
This is where the order ahead feature comes in. It hit 14% of transactions in Q4.
14%. That doesn't sound like a majority, but why is that number so significant?
Because of what it unlocks physically at the store. Dutch Bros is famous for long drive-through lines. Sometimes they snake out into the street.
Right. It's part of their brand, for better or worse.
For better or worse, if you can move 13% of your volume to order ahead, you can activate the walk-up window.
Right. I saw this in the report. The walk-up window is now 18% of the channel mix.
Exactly. So imagine the physical constraints. You have a line of cars. It can only move so fast. But if a customer orders on their phone, parks their car, walks up to the window, grabs their drink, and leaves, that is a transaction that never entered the drive-through line.
It's like opening a second invisible drive-through line.
It effectively increases the capacity of the real estate without building a bigger building. It is efficiency arbitrage. You are processing more orders per square foot per hour.
And then you layer on the loyalty program, Dutch Rewards.
Which is a beast, an absolute beast. 15 million members. And get this, 72% of all transactions come from loyalty members.
72%.
Yeah.
My first reaction is that seems dangerously high. Does that mean they have no new customers? Is it just the same people cycling through?
That is a valid concern, but in this context, I think it signals retention stickiness. Compare that to Starbucks or Chipotle, who are considered best in class for loyalty programs. Dutch Bros is right there with them, if not exceeding them in terms of penetration. It implies habit formation. People aren't just trying it, they're coming back again and again.
What is the actual business value of that, though, besides just having a lot of email addresses?
It means they own their demand curve. They have first-party data on 3/4 of their revenue.
Okay, unpack that. What does that let them do?
It means they don't have to guess. If they see traffic dipping on a Tuesday afternoon in Phoenix, they don't have to run a generic TV ad that hits the whole country. They can push a targeted notification to the 50,000 loyalty members within a 5-mile radius of those specific Phoenix shops offering double points for the next hour.
A digital scalpel instead of a marketing sledgehammer.
Exactly. It allows for sniper rifle marketing rather than spray and pray discounting. It protects margins because you are only discounting when you need to drive specific traffic at a specific time.
It makes their marketing spend much more efficient.
Much more. Management also mentioned their advertising engine is maturing. They've got paid media ramping up, and they've got CPG consumer packaged goods. They are selling retail coffee pods and creamers in grocery stores now.
I've seen those.
And this is interesting. They view the retail products not just as a separate revenue stream, but as a billboard to drive shop visits.
So it's a marketing tool.
It's top-of-funnel awareness.
Right.
You see the Dutch Bros creamer in the dairy aisle, you remember the brand, and maybe the next day you decide to drive to the shop instead of your usual spot. It's a flywheel. One business feeds the other.
It's a flywheel. Okay, let's shift gears to growth. Because you can't trade at the multiple BROs trades at which is high, without a serious expansion story. This brings us to the deep dive on expansion. And frankly, they pulled a move this quarter that I did not see coming. The Clutch move.
This was a surprise of the call for me, too. It's a real curveball.
They acquired Clutch Coffee Bar. Sounds like a generic name from a movie set, but it's a real chain. Walk us through the deal.
It's a regional player. They bought about 20 locations in the Carolinas, North and South Carolina, for roughly $20 million.
Okay, 20 million for 20 shops. That is suspiciously cheap. Or is that efficient?
It is highly efficient.
Yeah.
That's about $1 million per shop. Now, compare that to a greenfield build where you find a patch of dirt, get permits, pour concrete, and build a Dutch Bros from scratch.
What does a new build cost them?
In a hot market, that can cost $1.8 million or more. And that's just the build, not even including the land sometimes.
So they are buying these assets at a massive discount to replacement cost.
Yes. But the real value here isn't just the money, it is time.
Speed to market.
Exactly.
Yeah.
To open a new market like the Carolinas from scratch, organically, takes 18 to 24 months of permitting hell. You have to deal with local councils, traffic studies, utility hookups. It's a slog.
I can only imagine.
By acquiring Clutch, which already has the drive thrust built, already has the zoning, already has the physical infrastructure, they accelerate their entry into a key new region by a full year, maybe more.
So they just swap the sign, retrain the staff, and boom, they're live.
They will slap the Dutch Bros windmill on the building, install their point-of-sale systems, and these shops will open as Dutch Bros in Q2 and Q3 of 2026. It is a Pac-Man move. They're just eating up smaller competitors to grow faster.
And it signals a strategic shift, doesn't it? They aren't dogmatic about, we only build our own stores from the ground up. They are willing to be opportunistic. Does this open the door for more M&A?
I think it has to. It is a signal to the market that they are looking at the landscape of small regional coffee chains and seeing them as acquisition targets. If the unit economics of the Clutch deal hold up, why wouldn't they buy every optimized drive-through they can find in the Sunbelt?
It turns them into a roll-up story, which is very interesting for investors. But they're also experimenting with their own formats. We have to talk about downtown LA.
The urban experiment. This was another fascinating data point.
They opened a walk-up shop, no drive-through. In Los Angeles, the city where people drive to their mailbox. I was so skeptical about this.
Everyone was. But the results are completely counterintuitive. It is the top performing shop in the entire system since opening in November.
Number one in the system. A shop without a drive-through. How is that even possible?
It's all about digital. The order ahead mix there is 3 times the system average. People are ordering on their phones while walking from the office or the train, and they just grab and go. There's no line, no friction.
This changes the total addressable market argument completely.
It really does, because previously the bear case against Dutch Bros was, oh, this only works in suburbs and rural areas where land is cheap and you can pave a massive driveway. This proves the brand can work in dense urban cores.
If they can make the box work in downtown LA, they can make it work in Chicago, in Miami, in parts of New York. It raises the ceiling on the ultimate store count they could achieve.
It blows the ceiling off. It's a whole new avenue for growth.
So looking at the 2026 development guide, they are targeting 181 plus system openings. The goal remains 4,000 shops eventually, but the interim goal is 2029 shops by the year 2029.
Yeah.
I love that symmetry, even if it is a bit marketing heavy.
It is a good rallying cry for the team. But financially, there is a nuance in how they are building these new stores. They noted a shift toward build-to-suit leases.
Let's define that for the non-real estate pros. What is a build-to-suit lease?
In a traditional model, Dutch Bros would put up the capital to build the store. In a build-to-suit, the landlord or a developer pays for the construction of the building to Doug Bros' specifications.
So Dutch Bros doesn't have to put up the cash up front.
Exactly. In exchange, they agree to pay a higher monthly rent over the life of the lease.
So it reduces CapEx, capital expenditures now, but increases OpEx, operating expenses later. It's a trade-off.
Correct. You saw this in the numbers. Average CapEx per shop dropped to $1.3 million in Q4 versus $1.8 million previously. This preserves their cash liquidity to do things like, well, buy Clutch coffee for $20 million.
That's a balance sheet maneuver. It frees up cash for opportunistic growth. Very smart. Okay, let's get to the forward-looking numbers. The 2026 outlook, this is where the rubber meets the road and where things get a little sticky.
Right. The guidance print was strong on the top line. Revenue for 2026 is guided to between $2.0 billion and $2.03 billion.
So they're officially breaking the $2 billion barrier.
Breaking $2 billion, that implies growth of 22 to 24% for the full year.
And what about on the profit side? EBITDA.
EBITDA guidance of $355 million to $365 million. Solid numbers. But there is a headwind brewing in the coffee pot. We need to talk about the beans, the bad news. This is what the bears will cling to. Coffee commodity costs are elevated. Management flagged this explicitly on the call. They expect about 200 basis points of cost of goods sold pressure in Q1 2026.
200 basis points. So that's a full 2% hit to the gross margin line directly from the cost of beans. That's a big deal.
It's significant.
But I feel like I read about coffee prices going up 6 months ago. Why is it hitting them now? Is there a delay?
That is the lag effect. Large companies like Dutch Bros don't just go to the store and buy coffee. They hedge their commodities. They buy contracts for coffee months, sometimes a year in advance to lock in prices.
So they're insulated from daily price swings.
Exactly. So when spot prices for Arabica beans spiked late in 2025, Dutch Bros was still brewing coffee they bought at cheaper 2024 prices. Now, those old cheap contracts are expiring, and they have to start using the inventory bought at the higher prices from late last year.
It is like a snake digesting a meal. You can see the lump moving through the system.
That's a perfect analogy. So Q1 is going to be the pinch point. That's when that expensive inventory hits the P&L. They expect this pressure to step down throughout the year as they cycle through it and as spot prices hopefully stabilize. But Q1 margins will look a little ugly compared to the rest of the year.
Listen, the market needs to be prepared for that. Does this ruin the profitability story, though?
Yeah.
Or do they have ways to offset it?
No, it doesn't ruin it because they have offsets. This is where good management comes in. Let's talk about labor and occupancy. Labor costs actually improved. They gained leverage of 90 basis points due to better scheduling technology.
That is the boring stuff that makes money. Just being smarter about who works when.
It really is. And despite the coffee inflation, they expect to maintain healthy margins for the full year through SG&A leverage. Again, those corporate costs growing slower than revenue. They are targeting a long-term contribution margin of around 30%, which is best in class for the industry.
So let's zoom out. We call this the investor context.
Mm-hmm.
What is the narrative shift here? What does this all mean for the stock?
The stock had been punished. Really beaten down 38% over the last year prior to this print. The fear was slowing growth and saturation. This report completely resets that narrative. It says the growth algorithm is not only intact, it's accelerating.
It's a fundamental reset.
It is. If you compare BRS to the broader consumer discretionary sector, the XLY ETF or the S&P 500, BRS has underperformed significantly. This catch-up trade we saw in the after hours is fueled by the realization that their transaction growth is decoupling from the sluggish industry trend.
While Starbucks is trying to figure out its identity and McDonald's is focused on value, Dutch Bros is just running faster.
Exactly. They're playing a different game.
So what is the catalyst map? If you're an investor, what are you watching over the next 6 to 9 months?
3 things. 1, watch Q1 margins like a hawk. That is the trough. We know coffee costs are a headwind. If they come in better than the guided 200 BPs of pressure, that is incredibly bullish. It means their other efficiencies are working even better than expected.
Okay, Q1 margins, what's number 2?
2, watch the integration of the clutch shops in Q2 and Q3. Does it go smoothly? Do they see a big sales lift post-conversion? If that goes well, look for more acquisitions. It proves the M&A model works.
And number 3?
And 3, watch the food attach rate. They said a 4% lift now. If that creeps up to 5% or 6% as customers get used to ordering food with their drinks, that is pure high-margin revenue falling straight to the bottom line.
Okay, that brings us to the part of the show where we take off the responsible analyst hats and put on the reckless speculator hats.
My favorite part.
It is time for This Is Not Financial Advice.
And we have to give the disclaimer time. We are not financial advisors. Do not sue us. This is for entertainment and educational purposes only. Do not trade based on what we say. We are just 2 voices in your headphones.
Exactly. But if we were pitching a wild, maybe outrageous trade to an investment committee based on this earnings call, here's what I'm looking at. I call this the Carolina Caffeine Contango.
Oh boy. I love a good contango. Walk me through the logic.
Okay, here is the setup. We have a company expanding aggressively, buying up smaller chains, and hooking customers on sugar and caffeine with a 72% loyalty capture rate. That is drug dealer levels of loyalty.
Agreed. The retention is off the charts.
But everyone is worried about the price of coffee beans in Q1, the 200 basis points headwind.
Right. The market hates margin compression, even if it's temporary. Wall Street is notoriously short-term focused.
So the market is likely to hesitate or even sell off slightly in Q1 when those margins look thin. That is the trap. That's the opportunity. But we know, because management told us, that pressure steps down later in the year. And what happens later in the year?
The 20 converted clutch coffee shops in the Carolinas come online and start printing money.
Bingo. So you play the timing mismatch. Step 1. Wait for the inevitable Q1 margin panic dip. It might not be a big one, but the stock might stall. That's when you get interested.
Okay, so you're timing an entry point.
Step 2. Buy aggressive out-of-the-money leabies. Those are long-term call options, targeting late 2026. You want to give yourself plenty of time. You want to catch the back half of the year when the coffee costs drop and the clutch revenue hits the P&L.
That is actually somewhat rational, a leveraged long-term bet on the story continuing. But knowing you, there is a twist.
There is always a twist. Step 3. Hedge it by shorting a generic coffee commodity ETF, like JO.
Ah, the pair trade. So you're not just betting on the stock going up.
You want to isolate the operational alpha. You don't want to lose money if coffee beans go to $1 million a pound because of a drought in Brazil. You want to bet on Dutch Bro's ability to execute, to sell drinks, to integrate acquisitions, not on the price of the commodity they sell. You're long BRO's execution, short the bean.
That is sophisticated. I like it. And the outrageous twist. What takes this from a trade to a ticker talk special?
We call this the sugar rush roll-up. I am betting that Bros doesn't stop at clutch. I bet they see how well it worked, and they start acquiring every regional coffee chain with a decent drive-through in the Sunbelt. They become the Pac-Man of caffeine.
So the thesis is they become a serial acquirer.
The trade is basically a leveraged bet on Bros becoming a coffee REIT that happens to sell energy drinks. They're buying up real estate and cash flow streams.
A coffee REIT. That is ambitious. But looking at that $20 million clutch deal, it's not impossible. If they can buy revenue and real estate cheaper than they can build it, it's the financially prudent thing to do. They will keep doing it.
Exactly. They are buying speed. And in this market, speed kills the competition.
Well, it is definitely a high beta trade idea. But the fundamentals from this quarter, the transaction growth, the food attachment, the digital mix, they do support a bullish thesis, even if you aren't doing the sugar rush roll-up.
All right, let's wrap this up. Recap time for the listener who zoned out while driving.
Beat on revenue. Massive beat on EPS. Transaction growth is best in class, plus 7.7% system comps in a flat world. And that's driven by actual traffic, not just price.
Guidance breaks the $2 billion revenue barrier for next year. They're growing into a large cap company right before our eyes.
And they're innovating with food, digital, and now M&A.
Management said they are building a powerful growth engine. And honestly, the Q4 numbers suggest the engine is purring, provided they can navigate the expensive beans in the first quarter.
It is a story of execution. And right now, they are executing better than almost anyone else in the QSR space.
There you have it. A wake-up call for the industry and a triple shot for the investors. Keep your stops tight, your coffee strong, and we will catch you on the next print. This is Talk Tickers.
See you next time.